Hey everyone, welcome back to our Texas Real Estate and Construction YouTube channel. This is Aaron Trevino, and today we have Travis Watts. We're going to talk a bit about apartment investing. And if he looks familiar, it's because he has been a repeat guest. So it's a pleasure to talk to him a few years later. Travis, how's it going?
Hey Aaron, doing great. Thanks so much for the invite back.
Absolutely. And I know, wow, it's been a few years. I know a lot's changed in the economy and the real estate market, and it's a pleasure to sit down with you and see what you've been up to and how our investors can really just get ahead of the game and adjust to this new economy.
I'm excited to cover those topics with you. It's just real quick anecdotal note on the side. I've been part of the Best Ever podcast for almost 5 years, and I wound down my segment in April of this year in 24. And I thought, I'm going to take a break for like 2 years from podcasting, right? Just kind of reset. And then I thought, the market's changed to the point of people have to know more than ever what's going on because this is a fantastic time to get into this sector. So that's what prompted me, to come back here on the show. So anyway, just a little funny side note, but thanks for having me.
Absolutely. You're back and better than ever after a few years, right?
I guess so, but yeah, it's we'll get into it, but it's a really critical time for everybody to understand right now.
Absolutely. And we know that you're on the apartment investing side. I know a lot has changed, but what have you seen in terms of changes? What changes have you seen in the past 4 years related to apartment investing?
In short, I would say what hasn't changed, like we were on this slow, steady growth from when I got in the space as a full-time limited partner investor in syndications in 2015. It was, growing in popularity by leaps and bounds, from conferences to podcasts to crowdfunding platforms to the tax code supporting this sector. It was just it was gravy. You know what I mean? It was an easy ride, so to speak. I mean, not completely easy for a number of years. Low interest rates, bull market, good stuff. Everything changed in 2020, right? Starting with the pandemic, the eviction moratoriums, the inflation and stimulus that came out started to change insurance and wages and material costs. Then we saw supply chain disruption, and then we saw the Fed come in at some of the most aggressive rate hikes that they've done ever in US history. Cap rates went up, prices came down, lots of scary stuff out in the news. So everything has changed, in short. But I want to break it down for your audience to showcase what the opportunity is here in 24. As I mentioned, I'm very excited personally as an LP investor, investing very heavily this year. The main thing is that when interest rates go up in the commercial space, it's common on commercial properties to have short-term debt. A lot of people use bridge loans and, floating rate loans, and it's totally different than single family housing with a 30-year fixed rate, which most people aren't affected by this rate hike cycle in single family space for that reason. If you don't have to enter the market as a new homeowner or sell your property and buy another, then your payments aren't changing. Nothing's really changed, right? But for us in the commercial space, as rates go up, it gets less affordable for the next buyer, and they still want a healthy return and cash flow for themselves. So how do you adjust for it? If you can't adjust the rates, you have to adjust the pricing down, right? So we haven't seen discounting like this in nearly 15 years. I mean, it goes all the way back to the Great Recession, 2008, 9, 10. So 20, 30% discounts, even heavier in some other sectors like office, but I operate in the multifamily space. So the point is, rates have come up fast and aggressive. They've been held now for nearly a year straight. And the expectation and forward-looking forecast is for rates to come back down. Now, I'm not saying that they'll necessarily go all the way back to where they were, near zero, but they are expected to come down, okay, as inflation's come down, as unemployment's coming up, as our national debt is just out of control and skyrocketing. There's reasons why rates need to come down. So when that happens, no one has a crystal ball, including me, this will help boost valuations back up again. So what we find ourselves in is, first of all, we're millions of units behind as a country in terms of multifamily apartments. Okay, the National Multifamily Housing Council has said this year we need to build approximately 4.3 million new apartment units between now and 2035 just to keep up with demand. But what we're seeing in reality, aside from that fact, is that new construction and new permits being pulled to build have scaled down drastically to the tune of 40, 50% in a lot of markets across the US. So, where does that put us in 5 years? If we're buying the dip today, say we're getting, for simple math, a 25% discount, the fundamentals are strong, we're undersupplied on multifamily, and we're not building near enough to keep up with the pace of demand, and then rates and cap rates go lower in the coming years, right? This is like the perfect storm and reasoning for getting into the market right now. So if you've been on the sidelines, any of your listeners, and you've thought about this stuff, now's a great time to really consider getting into this market. While the things I mentioned may not be great news for existing deals that maybe you invested in 2020 or 21 or what have you, there's been a lot of pain over that. But I'm a dollar cost average philosophy investor. I always have been, and I'm certainly a buy the dip opportunistic investor. And both of those are at play here in 2024. So those are the quick, dirty highlights there, the top three in my mind of opportunity this year, and why I'm so excited for it.
Absolutely. And when you say buy the dip, you mean getting in now, given that we are in this housing shortage really for the next, what, 10 plus years?
Yeah, I mean, it's I don't have a crystal ball, but one thing I've been doing, Aaron, for the last 2 years is putting together this quarterly market analysis report that's free to any of your listeners and anybody. It's a public thing. You can go to ashcroftcapital.com and click on news, and there'll be a quarterly report. We're about to release the Q3 in a couple of weeks. And what I do is I pull reputable data, statistics, charts, graphs, stuff like this, nationwide from CoStar and Marcus and Millichap and CBRE and Urban Land Institute and U-Haul Stats and US Census and all these sources, right? So that I can dissect easier for people to understand where we're at and what the opportunity is. It's not an opinionated report where I'm saying, here's what I think and here's what I believe. It's just simply saying, here's the data. You can make a decision for yourself, but all signs point to a forward-looking, optimistic future here for multifamily. And we're starting to see the rents finally start to kick up and grow despite rates staying high because they've been relatively flat the last couple of years. So one thing for your listeners to remember is the old saying that still holds true, that the bull takes the stairs and the bear jumps out the window. A bull market can take 8 to 12 years on average to build. The bear market is short-lived, but it's steep and it's severe. And that's exactly what we've seen over the last couple of years due to interest rates. So we've already been in this down cycle 2 years. It's not an exact science, but they generally don't last much longer. And we're already starting to see the turnaround in the kickback. So yes, that was the long-winded way of agreeing with you, Aaron, to say buy the dip means that the last 4 deals we've acquired have been roughly a 25% discount relative to 2021 peak pricing. And the forecast is for valuations to increase moving forward and for the fundamentals to remain intact, as we've got the widest gap in US history between home ownership and renting right now of more than $1,000 per month.
Absolutely. And for anybody who has been sitting on the sidelines, maybe they have some cash or maybe they're just learning about, real estate investing in general. Are there any particular rules that an investor should know about prior to investing in a multifamily deal?
I joke about this and have for years. I wish there was just a simple place people could go, like a Yelp, if you will, for syndications. It's like, just show me the 5 out of 5s, and that's where I'm going to invest. But it doesn't exist. So you still have to do your due diligence and your homework. So the way I would answer that question, the rules, so to speak, is that you have 3 primary risk categories to think about. You have the operator that you're going to partner with, who they are, how transparent they are, how good their communication is, what their track record looks like, what they specialize in, just what their brand's all about. Then you've got the market, which is extremely important, that you're in great markets that are growing and expanding with people and jobs and companies. Then you have the deal itself. Is the actual investment deal solid? Is it good? Does it make logical sense? Is there upside to it, right? So I put the most emphasis on the operator. And so that's the first rule that I've always followed is let's call it 50% of importance, in my opinion, is who am I going to invest with? And then 25% perhaps, just making these up kind of on the fly, but 25% market, 25% deal. So they're all important. And, this is based off of 50 plus deals as a limited partner with all kinds of operators and what I've seen unfold. I've been part of great deals in great markets with poor operators, and we had a poor outcome, roughly to the tune of 50%, like I'm saying, of what was expected to what was actually reality. And I've worked with great operators where things just went sideways on a deal, but we still made a pretty healthy return, but the deal itself just didn't pan out the way that we hoped. So just something to think about for those getting in as those 3 risk points.
Sure. And there's so many different ways to invest. You could invest in new construction projects,
Yeah.
short-term rentals, RVs. There's really so many facets of the business. What's special about multifamily in particular, and why is that side of the business one of the best to invest in?
Yeah, well, to your point, so my bread and butter has always been residential multifamily apartments. That does not mean that I exclusively invest only in that sector. It was an easy parallel for me to move from single family residential into multifamily residential, right? It was just kind of like an easy leap, made logical sense to me. And I think it's really the fundamentals. It's a much needed asset class. Now, even though I invest in let's say car washes and what else, self-storage, stuff like that. Those have been fantastic in many ways, but I always kind of go back to the macro level here. Is it absolutely essential that we have those things in our economy? And the truth is, it's not essential. You can always do away with a storage unit. You don't have to go to a car wash, So, and I think about the same thing in the stock world, not that I'm a huge stock investor, but I don't just base it off of fundamentals and, profits and earnings per share and stuff like that. You got to look at, is the company really needed? Is it really in demand? Is it really essential for people? So you won't find me investing in, fad trends, and a new kind of shoe brand that pops up. I mean, the reality is there's millions of them and you may not need it, or canned soda or something like that. We could easily do without so many of those things. So the essentialness, if that's even a word, that's what I look for, number one.
Absolutely. And, in terms of, what your day-to-day is, what role are you playing in the deal itself?
Yeah, good question. At the end of the day, I'm a full-time limited partner, both with Joe Fairless and Ashcroft Capital and many other operators in the space. And that was a leap that came from 6.5 years prior to doing this stuff. Starting in 2015, I did residential single-family homes, fix and flips and buy and holds and vacation rentals and everything myself. So that's really who I am and what I do at the end of the day. Now with Ashcroft, I'm not a general partner. I'm not a capital raiser for them. I came on board in 2019 as a director of investor relations to help people understand the deals and what we were doing and why it's valuable and important. I moved over to director of investor education for a few years, where I did a ton of educational content and speaking on stage and doing this kind of stuff nationwide. And now I'm director of investor development. So I'm hyper focused these days on developing investors to better understand the market cycles and the fundamentals and the facts and the stats about what's really happening beneath the surface. Look beyond the scary headlines and let's dissect that and figure out what's true and what's not. So that's my focus today.
Absolutely. And to use a football analogy, I don't know, would you call yourself the quarterback or maybe the star running back?
Second string bench warmer. I don't know.
Okay.
I don't know. I'm assistant coach. I don't know what you'd call me, but my passion's always been, Aaron, just to help people with anything that has helped me or somebody I know. And that started way back in high school. I wrote a book in high school about how to achieve a 4.0 GPA with minimal effort, which was a terrible title for a book. I have to still laugh at that. But I didn't do it for money or popularity or fame or because I want to be a New York Times bestseller. I wrote this little book because I was doing some things academically that I was seeing real results in, things that I felt were relatively easy to do, but weren't being discussed. And so I just made a book to help people, and I wrote a book when I used to flip homes on how to do that, and then I just released a book this year called Passive Investor Tips, which was the conclusion to my 200 episode podcast with Joe under the Best Ever brand. And it's all the tips, tricks, strategies, formulas that have helped me and so many others be successful as a passive income investor over the years.
Wow, that's fascinating. You don't hear that every day. It could be one thing to be in your 30s, 40s, 50s and writing a book. But I mean, if I'm assuming what, 16 or 17 years old and you're writing a book, that's amazing.
It was just, it was to me, I looked at it very simply. It was, I could try to go around and talk to everybody I could possibly talk to and relay the same information 100 times, or I could just write a book and say, hey, this might help. Very simple. So
Yeah.
same thing today with the book. I'm donating all the profits and proceeds to this book, Passive Investor Tips, because I'm not in it for myself. Like I've made my money doing my investing and other things and ventures in my life. And so this is about giving resources to others that I saw a void out there in the industry, right? It wasn't being discussed or talked about. It's not your standard how-to book, right? Many people have written on that topic. This is more of the stories and the case studies and the out-of-the-box thinking that I wanted to share with others.
Do you think that's what investors are missing? Because it seems like there's a lot of, at least on YouTube, 5 steps to do this or how to do
Sure.
XYZ. Whereas for you, you're kind of focusing on the case studies. What exactly are new investors missing that's preventing them from actually getting into the game?
I think it's all about the psychology. And I think that's the unfortunate part about 2024. It was the unfortunate part about 2020. It was the unfortunate part about 2009. I used to work for a very large brokerage firm in 2016, and Brexit happened, and it was very unfortunate in that the best buying opportunities are presenting themselves, and the psychology is, I'm out. I'm on the sidelines. It's scary. I'm going to wait and see. Maybe next year will be better. It's the wrong mentality to have. And so that's really what I want to help people uncover is how do you find it in yourself to take action, even if it's in a small dose, so to speak, when these great market opportunities present themselves. Again, it's been roughly 15 years the last time we saw discounts like this in the commercial space. That alone is something to think about, because if we hit all-time highs again in the next 2 years, it's done. It's over. You missed out. And that's why I want to get on your show and express that to people.
That's fascinating that you mentioned it's more of the psychology, right? It always seems like the internet is kind of this endless stream of, oh, if you just do this or just do that, but it's almost like you're suggesting there's a mindset shift that needs to happen, right?
We all want the fast, easy, one-step solution. Everybody does. I do too, right? Like I want to have six-pack abs and be fit, and it's like, tell me the one food I should eat. It doesn't work that way. There's more than just what you eat, And but equally so, it doesn't have to be so convoluted. And, like to use that same analogy, the supplement market selling just millions and millions of these different pills and potions and formulas and powder. Like you can just exercise and eat right and get results. You don't have to have personal trainers and Peloton bikes and all this fancy stuff. But so you have to know enough, but you don't have to overwhelm yourself with the massive amounts of information we have. But there also isn't just the one thing, in my opinion, in most cases.
Right. It seems like you're trying to get people to strike that balance of, right, like doing your homework, making educated decisions, but at the same time also having that mindset shift.
Yeah, I think, analysis paralysis is a real thing. I've gone through it so many times throughout my life in different instances, and I see it as I've spoken to literally thousands and thousands of investors over the years. Some people, and again, I'm including myself back when especially, felt like I had to know 100% of everything before I could make a decision, right? Like what's that one thing I'm not asking, or what's that one thing I forgot to do? You don't need to do that, right? If you could just know 70%, or in some cases even 60% of what you need to know, it could put you on the right path in order to take action. So the balance that I found, Aaron, there was a year I set a goal for myself. I said, I'm going to read 52 books this year, which is one book per week. And I did that. And I don't recommend it because it limited me on what I could actually do as far as taking action. I was too busy reading and digesting content and stats and facts and all this stuff. And so the balance is nowadays, I'll read one book and then I'll go out and I'll implement what I learned to an extent. Maybe it's in a small dose. Again, I'll just take a little action. And then I'll go back to the education and I'll say, okay, how do I get a little more advanced in this? How do I go to level 2? And I'll read another book, or I'll get a mentor, or I'll take a course or whatever. Then I'll go back and I'll take action and I'll get a little bit better at whatever it is that we're talking about. And then I go back to the education, right? So I'm just seeing way too much in our world today of to your point, here's the 10,000 things you need to know. And it's like, you don't need to know all that.
I'm smiling because I have a habit of doing that, right? Really just getting I don't know, just kind of getting obsessed with the topic. I'm like, wow, this side of, this particular topic, this side of the business is so neat. I buy this book, it collects dust on my bookshelf for a little bit, and then I finally pull it out and read it, right?
Yeah,
Where it's,
right.
just taking it one step at a time and just implementing it.
In a lot of books, it's unfortunate, but when you do a book deal, and again, I'm generalizing, but they're going to want a 300, 400, 500 page book. They're going to want a lot in there. But the reality is, if it's a self-help or a how-to, you're limited down to maybe 3 impactful chapters that actually will make a meaningful difference potentially in your life. So when I approached Joe Fairless about doing this book, Passive Investor Tips, I'm like, this is what I'd like to see. I want it to be as short as possible, but as packed with information as possible. So it ended up somewhere like 145 pages, so relatively short book. Every chapter is like 2 or 3 pages max. It's just simply like, here's the deal, what it is, how it works, how it's important, how you can implement it, the end. And then we move on, And I love that. Man, I wish that would be like my one wish for our world, is like every self-help book could be that. It's like, just cut to the point. What are you talking about? Why is it important? How do I do it? And then let's move on. And so anyway, that's what I did to design that book.
Absolutely. It sounds much more easily digestible than just, hey, here's all this info, figure it out, right?
It's a book you can digest in like 1 to 2 days, or you could read 10 minutes a day and get through several chapters, or whatever. So I just wanted to be practical. To your point, too many people will put a book on their shelf for 5 years, and in most cases will never read that book. And I'm the same way. Someone's like, hey, here's a 500-page book, you should read it, it's good. I'm like, I don't know, I'm probably not reading it.
Yeah. Yeah. Ain't that the truth?
Yeah.
Absolutely. Well, we're about halfway through, a little more than halfway through the year. What are you looking forward to really for the remainder of 2024?
It's right now, in my opinion, and the deals that I'm seeing, and this started to materialize roughly maybe 12 months ago, I'm starting to see some of the best deals I've ever seen as a limited partner, generally speaking. I'm not just talking about Ashcroft, but just across the board. I'll give you a practical example for your listeners. We're closing on an Orlando, Florida deal that was built in 2021. It's a Class A property that's now fully stabilized, occupied, and cash flowing at a 5.5% cap rate, at a $97 million purchase price, 354 units. Okay, if we took that property the way it is today, okay, with the NOI that it has, and we went back to 2021 and we put it on the market, it would have traded probably for a 3 cap at maybe 130 to 140 million dollars. We're getting a significant discount and virtually a turnkey asset we're going to have to do very little with, and we're just going to let the market conditions improve over the next 5 years as we do limited value add to it. So I've never seen a Class A property trade like that at a 5.5 cap, where it's stabilized, occupied, and cash flowing. So that's just an example, just to paint that as a point of reference. Man, Aaron, I wish we could do 25 deals this year that are like that. But again, the psychology, the investor sentiment is down It's just down. It's down because of the interest rates and the valuation changes and the pause distributions and the capital calls that have happened and all these different factors. And again, while those exist and they're real, and I'm certainly never going to downplay that stuff, it's just part of a market cycle. We have to expect that as investors. And it doesn't matter if you're a stock investor or a real estate investor or a crypto investor. There's cycles. There's periods where things go down and there's periods where things go up. And we are in the bottoming out right now of the commercial real estate cycle. And in my opinion, there just couldn't be a better time over the next 12 to 18 months to get into the commercial real estate market.
Incredible. So, if someone is looking to get into the space, we will have your contact info in the description of the video, but is there anything you haven't said that you'd really just like to hit home for our audience?
Yeah, I just launched a site for your listeners that hopefully is easy to remember, speakwithtravis.com. And it's not only my calendar, which I'm happy to have a call with anyone and everyone and talk about anything on this show or otherwise. I put my calendar out there to the world and have for years now. And I just want to be a resource for people to help at least point you in the right direction or give you something that might be helpful or explain something in more detail. Speakwithtravis.com also has the quarterly market report that I alluded to, which I find to be very valuable. I don't know anybody else making a report like this, where it's an unbiased report across all these different reputable sources where you can read between the lines and figure out what's right for you and what your opinion is. And then we've got current offerings and opportunities and spreadsheets you can download for investment tracking. It's got all kinds of stuff. So speakwithtravis.com.
Speakwithtravis.com. So as mentioned, we will have that in the description of the video. Travis, thank you so much for coming on. It's been a pleasure to chat a little bit, talk about what you've been doing, how the past few years of going, adjustments y'all are making, and how to get in the game in this, really opportune time, right? Like you mentioned, the next 12 to 18 months, there's a lot in store and your wealth of knowledge. So thank you again for coming on.
Thank you, Aaron. You bet. Thanks everyone for tuning in.
All right, everybody. So signing off again, Travis, thank you. We will have his info in the description of the video, and we will talk to y'all next time.